In this video, we are going to talk about the DeFi protocols. So before starting this video, like this video and subscribe to our YouTube channel for future updates. Decentralized finance, or DeFi, is an umbrella word for a multitude of public blockchain applications and projects aimed at disrupting the existing finance world. DeFi stands for Financial Applications Built on Blockchain Technologies, and it was inspired by blockchain technology. Cryptocurrencies have grown into a trillion-dollar business, causing a wave of financial disruption around the world. Cryptocurrencies have a long history of invention that dates back to the 1980s, when cryptography improvements were made. Since then, a succession of events have changed the crypto world, with Bitcoin being the most well-known. Despite its meteoric rise over the last 12 years, financial services for Bitcoin have been reluctant to emerge, owing to its intrinsic lack of stability and adoption. Because of its substantial price fluctuation, mainstream banks will not accept a Bitcoin loan, making Bitcoin a poor asset for accurately planning any investment. Most smart contracts include Turing-complete programming languages, which allow numerous parties to interact without the need for a centralized middleman. The ability of blockchain to take use of smart contracts has made it an attractive platform for developing financial applications. Initially, humans bartered for commodities and services. However, as people progressed, so did economies. We established currency to make it simpler to trade commodities and services. As a result, coins aided in the introduction of new technologies and improved economic levels. Progress, on the other hand, comes at a price. Central governments have traditionally issued currencies that underlie our economy, which has given them more influence as more people have come to trust them. However, confidence has been breached on occasion, leading to concerns about the centralized authority ability to manage the money. DeFi was created with the goal of building an open financial system that eliminates the need to trust and rely on a central authority. DeFi, according to some, began in 2009 with the debut of Bitcoin, the first peer-to-peer digital currency built on top of the blockchain network. The idea of introducing transformation into the traditional financial world via blockchains became a necessary next step in the decentralization of legacy financial institutions thanks to Bitcoin. All of this was made possible with the development of Ethereum and, more especially, smart contracts in 2015. The Ethereum network is a second-generation blockchain that was the first to fully use the technology's potential in the financial sector. It incentivizes firms and enterprises to develop and deploy projects that make up the DeFi ecosystem. DeFi provided a wealth of chances for creating a transparent and robust financial system that is not controlled by a single company. However, 2017 saw the beginning of a new era for financial applications, with initiatives allowing for more than just money transfers. Financial markets have the ability to enable innovative ideas and create societal prosperity. Even so, these markets have a concentrated power structure. People who invest in the existing financial system hand up their assets to intermediaries like banks and financial institutions, which keeps risk and control at the forefront of these systems. Bankers and institutions have a history of failing to see market risks, as evidenced by the 2008 financial crisis. Without a doubt, when central authorities control money, risk builds up in the center, endangering the entire system. Bitcoin and other early cryptocurrencies were only decentralized in terms of issuance and storage, despite the fact that they were designed to allow individuals complete control over their assets. Until the advent of smart contracts, which enabled DeFi, providing access to a broader set of financial instruments remained a challenge. DeFi has evolved into a full ecosystem of functional applications and standards that benefit millions of people. DeFi ecosystems presently hold over $30 billion in assets, making it one of the fastest-growing segments of the public blockchain world. By allowing lending and borrowing, DeFi gave finance a new path. Decentralized financing, often known as open finance, provided crypto investors with opportunity to earn annual returns on their investments. Individuals might borrow money at a set interest rate thanks to decentralized borrowing. The goal of lending and borrowing is to meet the demands of the Bitcoin community while also serving financial sector use cases. Individuals can make predictions on the outcome of future events on prediction markets, which range from sports betting to politics to stock price predictions and more. DeFi allows anyone to participate in these markets. Smart contracts have long been suggested as a possible way to create decentralized prediction markets. People are witnessing a quantum leap in the new functionalities of money as a result of distributed ledger technology innovation. For the first time in history, the people of the world are shaping a global financial system. Everyone can participate in DeFi protocol governance and have a seat at the table where the world of decentralized finance is actively constructed. Despite some of the challenges that come with working on the cutting edge of innovation, the world of decentralized banking is on the road to prosperity. When the power to construct financial services is democratized, it's difficult to forecast how this field will evolve over time. However, when DeFi and fintech intersect and integrate, we'll reach a tipping point where fledgling financial technology becomes a component of a new financial system. One that embodies the ideals of speed, security, accessibility, and equality. In DeFi, coding faults and hacks are widespread. Because blockchain transactions are irreversible, an inaccurate or fraudulent DeFi transaction can't be readily reversed. In 2020, for example, a website called Yam Finance collected deposits worth $750 million just days after launching before crashing due to a technical fault. Furthermore, the smart contract code is typically open-source software that can be duplicated to establish competing platforms, causing instabilities as funds transfer from one platform to the next. The person or entity behind a DeFi protocol may be unknown, and investors' funds may be lost. Some DeFi protocols have been labeled as Ponzi-like by investor Michael Novogratz. DeFi has been likened to the 2017 ICO mania, which was part of a cryptocurrency bubble. Because of the skill necessary to connect with DeFi platforms and the lack of any intermediary with customer service, inexperienced investors are especially vulnerable to losing money. DeFi was responsible for half of all Bitcoin crime in 2021. This increase has been linked to a combination of developer incompetence and laws that are either non-existent or badly enforced. External hackers stealing from susceptible projects or rug pulls, when developers and influencers promote a project and then take the money as a type of pump and dump, are two examples of DeFi theft. A decentralized exchange can yet have centralized components, meaning that a central authority retains some control over the exchange. One such example is IDEX's refusal to allow New York State residents to place orders on the platform. Bancor, a decentralized exchange, was apparently hacked in July 2018 and lost $13.5 million in assets before suspending payments. Charlie Lee, the founder of Litecoin, came out in a tweet claiming that a decentralized exchange cannot lose or freeze customer assets. Government regulators may impose legal penalties on operators of decentralized exchanges. One example is EtherDelta's founder, who settled charges with the Securities and Exchange Commission in November 2018 for operating an unregistered securities exchange. Users are at a loss if their passwords or private keys are ever stolen due to a lack of KYC process and no way to reverse a transaction. Additionally, users who employ DeFi protocols may experience what is known as an impermanent loss. Despite the fact that liquidity pools DEX are the most popular, they may have significant disadvantages. Price slippage and front-running are the most typical issues with liquidity pool DEXs. Price slippage happens due to the nature of AMMs, automated market makers. The larger the deal, the greater the impact on the price. If the constant product AMM is used, for example, every deal must maintain the product XY equals K, where X and Y are the quantities of two cryptocurrencies, or tokens, in the pool. As a result, the larger the input quantity X, the lower the final ratio Y/X, which determines the exchange rate. The issue is more prevalent in large transactions or tiny liquidity pools. Front-running is a sort of public blockchain assault in which a participant, typically a miner, sees a forthcoming trading transaction and inserts his own transaction ahead of it, for example, by manipulating a transaction fee, making the initial transaction less profitable or even revoked. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.